definitely too early for bears to want to celebrate. This is one single day. You can't really read a whole lot into it. We're going to need something fundamental to work in our favor. However, I think we began to see some fundamental forces today materialize, or at least echo in a very strong way. And it clearly had an effect on the market. This was not some, just random sell off or anything. This was a very acute, very particular sell off in the areas that we'll kind of discuss about later. But I just want to say the areas that they occurred, the Qs in particular, were up quite a bit today in the morning at the open and finished the day down quite a bit today. So this is not some no big deal because we've seen, or some, just calm thing. We've seen this market be incredibly complacent. And the most complacent, as judged by the VIX, since February 2020, when the market was making all-time highs, as Apple was shutting down factories, saying they weren't going to meet revenue guidance, China was locking down, and we know what happened just shortly after that. There's sometimes, people say, oh, the market, will climb a wall of worry and keep going on. Well, sometimes it'll climb that wall of worry, but what if the wall just breaks or the market falls off the wall? I get it. I'm analogizing a little bit here. And, I'm not trying to be some, esoteric analogizer. I'm trying to keep things based in reality and based in facts a little bit. I'm not afraid to use my imagination. But anyways, the wall of worry might not be able to climb the wall of worry, is all I'm trying to say. It is a pretty big wall if you ask me. And maybe we took some cocaine or something to try and get up this wall of worry, because we have the CEO of OpenAI saying the AI frenzy's gotten a little out of hand. And I think in the past few days, we have heard the Fed say, oh, they might pause at the next meeting. Well, that's something that the market has required for several of the last Fed meetings, basically since August. Really, that's what caused that drawdown, was the idea that the market was expecting a Fed pause and a Fed pivot, and it didn't get it. And that time it sold off. This time it didn't do that at any of the Fed meetings, but it expected the very same exact thing. At least that was my interpretation of it. That's what it was pricing in the market for much of the time leading up to those meetings. And it didn't get it. And now it's finally starting to get it. But boom, we get body slammed by the Canadian bank. And this also happened with Australia, I believe, yesterday or something, where they pause and then they resume. And I think the market was celebrating so aggressively the idea that the Fed would finally skip after continuing to rally for several times after it didn't, or at least pause. And I think we need to calm down for a second. The bulls need to calm down for a second and realize that the Fed was very clear that the tightening cycle isn't over and the hiking cycle isn't over. So I'm not saying that this is what's going to break the camel's back or anything. What I am saying is I think the market has gotten very gluttonous. And I think that was emphasized with the first point I brought up about OpenAI CEO. The market has gotten very gluttonous. It's just been bathing in gains and bathing in gains, and people have been having fear of missing out, and shorts have been getting squeezed out the wazoo, even though, in my opinion, there's good reason to be short, fundamentally. And, maybe we can't climb the wall of worry. And maybe we've pushed it a little too far. And I get it. I'm not saying a specific catalyst. But I also think this is not going to be a specific catalyst type of thing. I think it's going to be a blunt type of thing. I think it's going to be more in line with what Ray Dalio said about this possibly being some sort of... Sorry, getting a call. Some sort of late stage debt cycle, debt crisis situation just what we talked about in Monday's video. And, he's referencing specifically the notion that more debt is going to need to be issued, but not as many people are going to want to buy it. Money supply is shrinking. That's going to be objectively true. So maybe even if the Fed doesn't hike, here's something to contemplate. I'm not saying it's going to happen, but it's possible. Even if the Fed doesn't hike, that, the issuance of new bonds into the market is going to make interest rates go up, because you're going to need higher interest rates to entice buyers to buy that bond. Let's not forget, bonds are even, they do carry some risk. Even if it's not default risk, it's currency risk, it's duration risk, and it's interest rate risk. Even on the risk-free rate of return, you still have all of those risks, even if you take away the default risk. So I think you've got a combination of things, and obviously I've been saying it for so long, and I've learned lessons here, and the market can remain irrational longer than you can remain solvent. And I don't think it's wise. Shorting is definitely more dangerous than going long. You can do your homework on a short, and the short can blow up in your face, and you can still go bankrupt because of that short. You can't go bankrupt being long. You can do all the work and be right and have the market go against you for a little bit and not even have to worry for a second. When you're short, that's not the case. You can still make money being short. I'm not saying it's not something to do. Markets move faster on the downside. That is a thing. They take the elevator on the way down and the stairs on the way up. But it's still dangerous. It's still dangerous. So I'm not trying to get over flamboyant about the shorts, but also not trying to say that it should be completely avoided. Anyways, there's a lot of things happening today. But at the same time, it's one day. We can't get too excited as bears, or those of us who are bears, about it. We have to let time be the decider here. We've got all these theories. We're seeing all these things, all these cracks, all these leading economic indicators, all these signs of consumers not paying various debts. The typical spillover effects those have. And the idea that we're going to have both low inflation and low growth is not a very good combination. It's just not. That's like the worst combination for asset prices as far as I'm aware. So we just got to see what happens, okay? It's one day. I don't want to make too much of today. I'm liking what I'm seeing though. And I'm seeing some pretty important things happen today, and even reminding me that the Fed might hike yet again. And like Kashkari said, who said pause, they might have to go to 6%. This is what John Taylor, who created the Taylor rule, also believes. And that's what Bullard's paper was about, was using the Taylor rule. And Bullard's paper was the one who got me to realize that I had to calm down my expectations on the Fed. But maybe that was a mistake. So ultimately, we'll see what happens. That's today's video. We'll see what happens. Until next time, peace out.